The subject of how to pick stocks goes back a little bit with my own personal history. It really started by meeting some folks in the company I was working with. They had an investment club. They asked me to join. I joined a club, and we learned a lot of good things. And I read a lot of books, and I read a lot of what I thought was a lot of good stuff. But as I went along, I hit some winners, and I had a lot of losers. I also had the pleasure of selecting a broker who believed in buying stocks that were going down and selling them when they went up. And he would call me and he'd say, Bart, you know, this great stock, XYZ, is down 3 points or 4 points. Now's the time to buy it. And I said, sure, you know, let's buy a couple of hundred shares. And before I knew it was down 10 points. And so, and I went along all through the 60s. And of course, you know, the market peaked in 69 or thereabouts, and interest rates were going up, and I didn't understand any of the stuff we just talked about. But I went through until 1974. In 1974, I just got so discouraged that in December, the middle of December of 74, I sold every stock I had, except my company stock, which I was hoping would go down because I never intended to sell it until after I retired so I could accumulate more. And it performed very well in that respect, incidentally. Anyway, I sold at the very bottom of that vicious bear market, very bottom. And just a couple of weeks later, you know, the market takes off. And there are these stocks that I sold that were moving up, and I said, you know, I'm glad I quit. I hate this stuff. You know, I really didn't have a clue what was going on. Anyway, in January of 78, a blizzard hit this town in late January, and I lived in Brecksville then, and we got snowbound, and I had nothing to do, but I happened to have a copy of Forbes. And so I picked that up and began looking at it. And in those days, Forbes magazine had their listing of business and industry, the ranking of business and industry, and they'd rank 500 companies by a return on equity, by sales growth, and by price performance. And I thought, well, I'll just go through here and I'll pick the 10 best stocks and buy them and keep them for a year. And as I got into that, I began to realize that I didn't have a clue about what I was doing. So I went into my study and I wrote those formulas that you just saw. At the end of the day, I was calculating values for the stocks in the Dow Jones Industrials, and I was amazed by what I found. And so that was the basis of what happened to me. Another thing that I think helped me quite a bit is that I was trained as a chemical engineer in school. And people say, well, how did that help you with the stock market? Well, what we had to do in chemical engineering, we had what we call unit operations labs. We went into these laboratories and they had equipment. And we would run the equipment and we changed things. We changed the temperature, we changed the speed, we changed the pressure, we changed the feed rate of various chemicals. And we saw the results of what was going on. And then after everything was done and we had logged all this data, it was our job to interpret that data and then write formulas that would allow you to use that information in a different scenario, a larger size piece of equipment, for example. And so we got used to looking and accumulating data and information and writing formulas, mathematical formulas, that would emulate the performance of that piece of equipment. And so when I looked at the stock market after 1978 and I started getting interested in it again and involved in it very much, it was clear to me the market speaks to you, and this, I didn't create this, but there's a guy by the name of Granville that said you had to listen to the market. And I finally realized what he was saying is you have to watch the price behavior and the volume behavior of the market. He said that's what the market talks to us in. It speaks in terms of price and volume, and that's the output. That's what you get. And you know, this whole field of technical analysis, they have thousands of things on how you interpret what the market is saying. But that's how you listen to the market. So I started putting those things together. That's how we ended up with VectorVest. But that's a long story. I want to move on to how to pick stocks. But what I wanted to do is, the first thing I wanted to do is I wanted to find big winners. I would look in the paper and I'd see the 52-week high and I see the 52-week low, and I'd say, you know, it's just stock after stock after stock where the high is about twice the low. Why can't I find those stocks? So I wanted to find big winners. And I felt the way to find big winners is to find undervalued stocks. Mark, I would want to favor undervalued stocks. Undervalued stocks increase the odds of winning, they increase the rewards for winning, and they decrease the downside risk. So the question now becomes, how do we know when a stock is undervalued? The first thing that most people do is they look at PE ratios. PE ratios are famous. They're the most common measure of valuation. The data are readily available and easy to understand. Even I can understand it. And good for making comparisons with other stocks and for historical reference. But there are some serious problems with using PE ratios. The data are incomplete. If you look in a paper, you'll see a lot of stocks. Maybe 20 to 30% of those listings don't have any PE ratios listed. And the reason why is they haven't traded on the market for at least a year. Or they may have negative earnings, or they may have zero earnings. And there's a lot of reasons why they don't list the PE ratio. And the biggest problem, the absolute biggest problem, there is no independent frame of reference. I love listening to guys that say, well, you know, that's a high-tech stock, so a PE ratio of 40 is okay. This is a bank stock, so PE ratio of 10 is good for a bank. And 40 is good for high-tech stock. I said, what? You know, a dollar is a dollar. You got to pay help. You got to pay for your goods and services in the same monetary unit. So what's with this difference in PE ratios all the time? I guess, you know, one guy told me, he said, some stocks have sex appeal and others don't. So we got to go out looking for sexy stocks. And that, for many years, was high tech. And maybe it still is. The levels change with inflation and interest rates. A lot of people don't realize this, but you remember those graphs that we look at? You remember those two graphs? So the levels change with inflation and interest rates. So you have to know what a reasonable PE ratio is. You really have to know what the inflation and interest rate is at that point in time. You have problems when earnings are zero or negative. You divide by zero, you get infinity. To me, in my mind, I leave more questions than answers. So let's go to the next slide. And this is something I learned when I was in that investment club. The NAIC said the way to estimate value, whether a stock is over or undervalued, compare the growth rate, the earnings growth rate, to the PE ratio. So if the earnings growth rate is greater than the PE ratio, a stock is undervalued. So now we have an independent measure, standard of measurement. And once again, it's good for making comparisons. It introduces earnings growth into the assessment and has a commonly accepted standard of reference of 1. Even the great Peter Lynch used this as a measure of valuation. Of course, they use it upside down. They use what they call the PEG ratio. They use the PE divided by the growth. But if you do the math, this is the way it comes out. And I don't have time to do it for you, but we can do it. And the other thing is, a lot of people don't understand that this ratio, whether it's overvalued or undervalued, that varies with earnings and interest rates. The disadvantages also are good earnings growth data are hard to find. The standard for reference is not well understood, and a standard of reference changes with interest rates. Right now, with low interest rates that we have of 6%, a ratio of growth to PE ratio, a ratio of about 0.36 is valid, because this ratio of 1 only is valid when the interest rate is 10%. Right now, interest rates are about 6%, and it's a square function, so 6%, 0.6, the squared is 0.36. And if you go into VectorVest stock analysis, and we have this data in there, and you'll see what the ratios are for every stock. Let's go on, Mark. Another thing to do is to look at earnings yields versus interest yields. I talked about this. There are some advantages here. No problems with zero negative earnings. You can use to make comparisons with other stocks. Use a current interest rate as the frame of reference. And that's the best frame of reference you can use, because that's what people are using to decide whether they buy bonds or buy stocks. Disadvantages: data are incomplete, levels change with inflation and interest rates. Let's move on, Mark. Intrinsic value versus price. Okay? No artificial reference standard is required. The validity of the results has been demonstrated over the last 28 years. That graph I showed you on a Dow, VectorVest Dow versus Gary, my friend, my old friend, it blew his mind. He says, why is this going up so fast? I could spend the rest of the day telling him why, and he still wouldn't understand it. But anyway, data are available, all right? And where are they available? They're available in VectorVest, of course. So let's move on, Mark. And that's the formula we talked about, and we take the data and plug it in there. Let's move on. And look at the way this thing has compared over the years. And sure, this thing took off like a bird here. Gary won't sleep tonight until he figures that out. He probably won't even watch the Browns play tonight. Gary, where are you? There you are. I still love you. That's right. You got to have everything explained. Okay, Mark, let's move on. All right. So the second thing I wanted sure bets. Now, we all know there's no such thing as a sure bet in the stock market. But what I was saying to myself, this is exactly what I did. I said, I was so tired of buying stocks that didn't perform that I had to increase my performance level of selecting stocks that most likely would continue to go up. And so what I did is shown on the next slide. Well, on the slide after this one. I said favor safe stocks, and safe stocks are less volatile and have better price growth persistence. Okay, let's go on, Mark. So, how do we know when a stock is safe? You look for outstanding financial performance. You look for companies that have consistent, predictable earnings growth, above average earnings growth. And what I was looking for is I wanted companies, I was doing this in 78, remember, and early 78. I was looking for companies whose earnings kept going up year after year after year, quarter after quarter after quarter, all through the recession of 73 and 74. I wanted companies whose business was so good they weren't affected by the economic cycle. That's where I started from. I like companies whose earnings go up and up and up and up, independent of what the economy is doing. And there are companies like that. And one of them was Coca-Cola back in those days. And another one was McDonald's. So this, to me, is the key to our safety analysis: consistent, predictable earnings growth. Now, you have to say, well, if I have a company whose earnings are going up 15% a year, year after year after year, and I buy it, okay, and it's been doing this for 40 quarters, what is the chance that the quarter I buy it, it's not going to go up? Well, if you were me, the chances were good. But I had to go that direction. And this is what I did. And you got to think about another thing. If the earnings are going up 15% a year, year after year after year, before you know it, that company's going to be making a lot of money. And if it makes a lot of money, The company's going to get very wealthy, and if it gets wealthy, the price of the stock is going to go up. Sooner or later, it will. Even if they buy themselves out, the price has got to go up. So that's the key. We're looking for a steady increase in stock price. Even if the company has great financial performance, if the stock price isn't performing, it's not doing you any good. Way back when I got started, there was a company called Gulf Western, and they had a guy by the name of Charles Bludorn that was the CEO, and the analysts, you probably know him, Don, and you know of him, and the analysts in New York hated this guy, and their PE ratio was like 4, and this guy was making deals all the time, and their earnings were going up. Stock didn't go anywhere. The day he died, the stock took off. Low debt equity. I don't like companies that have a lot of debt, and high sales revenue. And what that means is larger companies are better than smaller companies as far as safety goes. Let's move on, Mark. Third thing I wanted was steady profits. By steady profits, I'd like to see my portfolio go up and up and up and up. I don't like to see it go up and down and up and down. And so how do I do that? Mark, let's look at the next thing. I favored stocks in rising in price. I figured, if you own stocks whose prices are going up all the time, your profits ought to be fairly steady. They'll be steadier than if they go up and down. So stocks with rising prices have investor recognition and are already doing what you want them to do. And frankly, ladies and gentlemen, one of the toughest things in the world to get people to do is to recognize they ought to buy stocks whose prices are going up, because we're all trained, we're all ingrained on buying stocks when the prices go down. That's what you hear on Wall Street, and that's what you hear, this guy on TV goes, mowing back. Well, he got a couple of mowing backs last month, I'll tell you that. Let's go to the next slide, Mark. So how do you know when a stock is rising in price? You look for new 52-week highs. And buying stocks that hit new 52-week highs is a very powerful strategy. It's a good strategy. The guy that got me into this mode of buying stocks going up in price wrote a book. His name is Richard Blackman, and the name of the book is Follow the Leaders. And he said, by rising stocks in rising markets, in rising industry groups, and he said in that book, he wouldn't buy a stock unless it hit a 52-week high. Okay, another thing is high relative strength. You get relative strength ratings in a variety of places. One of the best places to get them is in Investor's Business Daily. High relative strength means these stocks are outperforming the indices of the stock market. So you want to get stocks that are outperforming. The easiest way, of course, to know whether stock is rising in price is moving average crossovers. You get 10-day and a 30-day, or the 50-day and a 200-day. If the shorter moving average crosses above the lower, you got rising prices. So, Mark, let's go on. The mantra is to buy safe, undervalued stocks rising in price. Move on, Mark. So how can we find safe, undervalued stocks rising in price? We find stocks that are hitting 52-week highs. I used to buy Barron's magazine before the Apple computer came out in the 80s. I'd buy Barron's magazine on Saturday, and they had a table there of stocks that had hit 50-week highs in that previous week. So I get that table, and then and they listed them alphabetically, and I'd start looking. I'd look the stock up in the data set, and I'd look for the stocks that had hitting 52-week highs, but still had low PE ratios. And then I would whittle it down to 8 or 10 of them, and this is where the hard work came. Check their financial performance, which meant I had to go to the public library and dig out the Standard & Poor's reports to see if I can find them in Value Line or do whatever. And once I did that, I tried to select the stocks with the lowest PE ratios and the best financial performance, and there was a lot of subjective reasoning at this end, okay? But it was a lot of work. Now, a lot of investors I meet love to do a lot of work before they make a decision. These guys that use this, what is this thing called, CanSlim? They work like dogs to pick a stock. They can go all night. And these guys that love technical analysis, Oh, they really enjoy sweating it out. You know, they do all these things and look for this and look for that. Once they, you know, have done all this work, they get so exhausted they can't even make a decision. And that's called the paralysis of the analysis. Let's go, Mark. So, how can we find undervalued stocks rising in price? The answer is obvious. You check VectorVest. Once we got the Apple computer, we started putting all this stuff in the computer. It became easy. Mark, let's move ahead. Okay? Now, in VectorVest, you'll see it in the next talk, we rank everything by an indicator we call value safety timing indicator. And the stocks with the highest VST ratings supposedly have the best combination of value, safety, and timing. And the question becomes, well, how do these stocks perform? So we ran tests. Portfolios of the top 20 stocks ranked by VST Vector have made money 99.46% of the time for the last 11 years. Unbelievable. Unbelievable. In fact, the advertising agency we're dealing with doesn't want us to use that number. He says, nobody's going to believe that crap. Okay? Mark, let's move forward. What we've done, Mark, first of all, let's make a demonstration. Let's go into VectorVest and go into Stock Viewer. I'll show you exactly how the test was run. Go back to January 5th or whatever it was, 1996. Of course, I'm going to demonstrate it with a test that works. All right. Now, what we're going to do is we have a tool in here. These are the stocks that were ranked by VST Vector back in January 5th, 1996. And we have a tool that we call Quick Test. And take that to 20, Mark. And click OK. And this tool is going to take us from the prices that began in January of 1996 to the prices as of August the 24th. And you know, the market just had a nice drawdown. Okay, so we're not even at an advantageous point here. But we had 19 winners and 1 loser. And the average gain was 317% for an average annual gain of 27.24%. And there are a lot of people in this room probably that would kill for that. The VectorVest composite, all the stocks in the database, they changed 38%. That's 3% a year. Okay? Now, Mark, close that. And go forward 1 year. And don't use January, use February. Use February the 3rd. Oh, February the 7th is fine. Let's try that again. All I know is this better work, Mark. This is only up 172%, but we had 19 winners and 1 loser again. Okay, go to March, first weekend in March in 1998. What I'm doing, I'm not quite picking random dates, but you're free to go back and pick all the dates you want and test it over and over and over again. If we had the time, we'd run the birthday game. I'd ask you what month and day you were born, and we'll run the birthday game, and here you got 126. In other words, what that previous claim said, this test is going to show a profit 99.46% of the time. Now we can go back and look at that graph, that chart. The test was to see what happened to this group of 20 stocks over time. Now, in this test, I don't know whether you can see these numbers. These tests were run by the simulator. They did the same thing. You know, and we ran 2,611 tests. We had 2,597 runs. That means that we had 14 times out of this 2,600 tests that didn't make money. And those are the 14 times I bought it. Okay? And what we have here is a distribution. And this big bar here is a distribution from 0 to 50%. In other words, it says close to 90% of these returns were between 0 and 50%. We had some returns all the way up here to 125%. I guess we even had some way out here, Mark. I'm looking at that. Okay, and it said the average gain was 103%. The average annual return was 18%, and the percentage of stocks that went up was 68.15%. The day that you started the test, the starting day. Yeah, we started from the very first day, and we went forward day by day by day by day. Now, what is it that causes this to happen? Everyone should know the answer. Earnings. Because all of these stocks had earnings that were going up. All of these stocks had, I wouldn't say above average RSs, but they had good relative safeties, and they had the fundamentals built into them. They had the fundamentals we talked about. They had rising earnings, and they had the consistency and predictability of financial performance.